And China has problems anyway. If there was no COVID in China, they would be collapsing anyway because of real estate, demographics, corruption, pollution, and higher oil and gas prices, inflation, and they're draining U.S. dollar reserves. So they're an economic basket case with or without COVID, but COVID makes it worse. Europe is already in recession. It's going to get a lot worse. I hate to use cliches, but I guess it was Game of Thrones. They said, winter is coming. Well, winter's here. It's getting very cold very fast in Europe. They don't have enough energy. The US and UK together blew up the Nord Stream pipeline. That's not going to be a source of natural gas. And now they put this cap. I say they, meaning NATO, the US and EU, put a cap on Russian oil prices. Well, the one thing we know about price controls is they never work. Like, they just never work. You can guarantee the price will be higher because you'll create shortages and move things to the black market. So Europe's in a recession, going to get a lot worse. China's in a recession, going to get a lot worse. Japan just kind of falls victim to everything else we're describing. When consumption's down, there's demand destruction because of higher interest rates. Japan's an export powerhouse. Well, guess what? Their exports start to shrink drastically because no one's buying their stuff. Same for South Korea. So what we're looking at, Julie, is a global recession, and those are rare. It's one thing to say, well, Germany's in a recession, or the U.S. is in a recession, or Japan. Japan's had 9 recessions in the last 30 years. They're in a 30-year depression is a better way to describe it. But usually there's some economy somewhere that's doing okay, and kind of, actually they used to use the phrase locomotive. It's the locomotive that pulls the rest of the train, out of the ditch or up the hill, as the case may be. But a global recession, which we did have in 2008, with the exception of Australia. Australia seems to be recession-proof, but they did have a recession in 2020. But we're looking at a global recession. That would be if we're lucky. If we're not lucky, we'll have a global financial panic on top of that. So this is the bigger picture, the macro picture, but it comes at the same time that we see a supply chain breakdown. There'll always be supply chains, but the future supply chain will look very different. And right now we're kind of in a muddling through period, and not very efficient period. But then the second part of the book is about money, and it has 2 chapters, one on inflation, and we all get inflation. I always say, I may be an analyst, but I put gas in my car and shop for groceries just like everybody else. So I get the inflation side of it, but I have a separate chapter on disinflation and deflation. And that's coming very fast, and no one's ready for that. You can see it coming, but right now everyone's kind of got the inflation mindset on, but the deflation is coming very quickly. We're paying higher prices, but a lot of this is because demand is inelastic, meaning you got to pay the higher price no matter what. If you have to fill up your Ford F-150 pickup truck because you got to get to work or do your job or take the kids to school, or whatever, and it used to be $75 and now it's $150 twice a week, you still have to do it. It kind of doesn't matter because you need the gas and you need the truck. Now, where it does impact the economy is if you do that, it's $75 that you don't have for something else. In other words, you're like, okay, I just paid a lot more to fill up my truck with gas or my SUV or whatever, but now I'm going to, not go out to dinner, not go to a concert, not go to a sporting event, not buy a new suit of clothes, et cetera, because I can't afford it because I put all my money in the gas tank. And the Fed can't do anything about that directly. The Fed does not drill for oil. The Fed does not plant wheat or corn. They do not provide fertilizer. They do not drive trucks. They do not refine diesel fuel. In other words, when you look at all the bottlenecks that we've talked about, the Fed doesn't do any of those things. So they can't affect the supply side of the equation. All they can do is destroy demand by raising interest rates, which they're doing. We saw mortgage rates go up and housing prices come down, and a lot else. Prices are actually starting to come down. We'll talk about that in a minute. But my point being, if the inflation is coming from the demand side and you do some demand destruction, okay, that works, although it can be extreme, as it was with Paul Volcker. But if the inflation is coming from the supply side, think about how much demand do you have to destroy to affect the supply side. It's not coming from the demand side, it's coming from the supply side. The answer is a lot. You have to create a severe recession and much higher unemployment to control supply inflation from the demand side. So they're out to destroy inflation. But here's what the markets don't see. Here's what the Fed definitely does not see, and what very few analysts see. Supply side inflation can feed to the demand side. Demand side inflation can feed on itself. But supply side inflation alone does not feed on itself. It tends to destroy itself. There's an old saying, the cure for high oil prices is high oil prices. In other words, if you make them high enough, and going back to what I just said about putting gas in your tank, think of all the things you're not spending money on. And that causes business failures, layoffs, higher unemployment, lower velocity of money. You stay home, like you said, you don't go out basically. And that's what's happening now. So we're starting to see inflation come down. When it comes down a little bit from 8.2% to 7.7%, people go, oh, it's still high. Well, it is still high, but that's a noticeable drop, and we've seen that a couple of months in a row. What's going to happen faster than markets and investors expect is that this inflation is going to come down so fast, it's going to be a strong form of disinflation. Now, disinflation is still inflation, but it's lower inflation. And in terms of response functions, it bears a closer resemblance to deflation than it does to inflation, even though it's still a form of inflation. When inflation is coming down, what else is going on? Well, real interest rates are going up, and the economy is slowing down. And then it could even tip into deflation. That would be a shock to the system. In that world, cash is your best performing asset because the real value of cash actually goes up in deflation when everything else is crashing around you. So yeah, we're in inflation right now. It's painful, but it's starting to fade more quickly than people expect. And my forecast, based on a lot of analysis, and it's all in the book, Sold Out, is that this disinflation, borderline deflation will prevail. And by really just in a few months, January, February, March 2023, if not sooner, we're going to be in a very severe recession. And people are going to be surprised at how quickly inflation comes down, and they won't be positioned for it in terms of their portfolios. I mean, for example, a 10-year Treasury note would be a very good performing asset in this world because yield to maturity on 10-year Treasury notes been recently 4%, but now it's around 3.5%. That could come down to 2.5% in a heartbeat, even lower, and that would produce huge capital gains. So it's a big deal for investors and asset allocation and portfolio management, and a lot of people don't see the disinflation coming.